Alright traders, I'm back again with another video, and today we're going to take time to discuss a more advanced Ichimoku breakout trading style. And with that we're going to use an indicator. So that indicator we're going to use is going to be the Williams Ultimate Oscillator. Now I'm not going to get deep into the calculations of this oscillator because it's a little bit advanced and a little bit complicated. So I'm not going to get into that right now. Maybe another time we can really break it down. But what you want to know is how it works, what it's doing. And just like most oscillators, it measures overbought and oversold territory. It measures the momentum of the market. And this is what we're going to use for breakouts. We want to get the momentum. We want to have good momentum to get into a breakout. And we're going to use momentum using divergence. All right, so this, first of all, this ultimate oscillator is very dependable because it uses three three time frames to show the momentum of three different time frames, unlike your stochastics or RSI, which is showing you that one period time frame. So it uses the 7, 14, and 28 time period. Now you notice each number is doubled, so 7, 14, 28. If you go and change the oscillator, each number needs to be doubled. Now I'm using the default settings, 7, 14, and 28, and we're going to get into this right now and see how we're going to trade this. Now what you're going to look for is divergence. So divergence is going to be, there's a couple of types of divergence. There's hidden divergence and there's regular divergence. We're not going to get into the hidden divergence right now. We'll do that on another video. We're just going to get into the regular divergence. Now with regular divergence, there's going to be bullish divergence and bearish divergence. So first let's talk about the bullish divergence. Bullish divergence is going to be when the market's making lower lows. So the market's making lower lows, here you go. But the indicator is making higher lows. So here's a low. This is the bottom low of the indicator, but then it made another low, but that low was higher, and then this low was higher, and then finally it went up above the negative 50, the 50 level here. So all along that shows you that the buying pressure is strong. So the momentum is strong for buying, and you can see that the market momentum is strong going upwards, and you see what happens here. The market broke above the cloud and we went into the trade. So what you're going to do is you're going to look for divergence, and you're going to look for that usually at the top of a run or the bottom of a run, and start looking for the oscillator to make that low, and then look for the oscillator to make another low, but be aware that the low of the price is even lower. So that's showing you divergence. Now you see this low, so you usually have to draw a line, or you can see it if you can see it, but drawing a line will help you be more visual. So you'll see that the lows are going higher on the oscillator. So now we broke above that 50 level. Now we want Ichimoku to break above, we want price to break above the Kumo cloud. So here it is. Here's where we get into the trade right here when we break this cloud. And this is letting us know that this is going to be a strong trade because we have the momentum on our side based off of the oscillator telling us this. Now like I said, this indicator is a little more reliable than your stochastics and your RSI, MACD, because as far as measuring divergence, because like I said, it measures that three time frames, so it's taken into to account the shorter term, the medium term, and the longer term time frames. All right, so you'll see that, whereas like another indicator is taking that single time frame into account, and it's going to make that move, that big move, quickly. This is going to be more subtle, and it's going to show it based off of those three time frames. Now when price broke this cloud right here, we could have said this was going to be a strong momentum trade because it's showing us that with price breaking above this negative 50, this 50 level here, and the momentum of the oscillator going upwards. So we break the cloud, we enter on this bar here, and then we have our stop loss a little below the Kijinsen as usual. So that's bearish divergence. That's bullish divergence, sorry. Now let's look at bearish divergence. That's going to be when price is making higher highs, but the oscillator is making lower highs. All right, so here goes the market making a high, and then it makes another high right here. All right, well look at this high. The oscillator is really high, and then it comes, makes another high that's not as high as this high, that's higher than the previous high. but then this high is way lower. All right, so then what happens? The market breaks down, breaks below the Kijinsen, and now we're waiting for the break of the cloud. It breaks the cloud, and we're below the 50 level on the oscillator. This is looking like a strong momentum trade here. So we enter the market here. Now the stop loss will be way up on your Kijinsen based off of the Ichimoku rules. Now this would be a big stop loss here. So there's a couple other things that you could do. Like I said, you always can use your um your fractal levels, and you can also use your previous candles. So you'll have to determine which stop loss is best for you based off of your money management. But you could see what happened. The momentum showing us on this oscillator was very strong. You could see the steep slope, and you can see what happened. Price just dropped. This would have been a really good trade. Okay, and then you can see again, here's how it's going to let you know that maybe your trade is coming to an end. Okay, so now we see here's a level here. We can see that. And now we could see where the momentum is dying on the trade, because we came all the way down. Here's the lowest low of the oscillator. So if we went there, we could look at this and see what's happening. Now when we got this low here, and it was above this low right here of the oscillator, then this would have told us that the trade is weakening. Our momentum is getting weak, so we might want to be looking to get out of our trade. And then when this level crossed over the 50 level here, and you see price crossed over our Kijinsen, this is telling us to be out of that trade. And so that would have been where you get out of your trade. You could see that's divergence again. That's bullish divergence. And then finally the market went up. Now if you took this trade, you didn't get in this trade, but you took this bullish divergence trade, you see where the market made lower lows, the indicator made higher highs, and then finally price came price came above the Kijinsen, the Kumo. We broke the Kumo, and we're above the 50 level on the oscillator. When we broke that level, we would have got stopped out. Okay, you see this would have stopped us out because our stop loss would have been at the Kijinsen. But then we would have looked to get back into the trade because we're above the 50 level, and we based that off of that divergence. And here's where that candle opened up, went above the cloud. So we had a pullback. You can see the cloud level held as resistance, as support, sorry, because you're coming down. So this level held as support, and then price went back up above the Kijinsen, let you know that you have a change of trend, possibly change of the trend direction, and you got that. And then your 50 level, you were above that 50 level, so you could get back into that trade. Now where you would put your stop loss this time, I would put my stop loss below that fractal level. So you lost this trade, but now you make up for that loss with this. Okay, and then now we're here, and you can see both price and the oscillator are starting to point downwards with as far as making lower highs. So we know this may come to an end. Okay, so that's looking at this Euro Aussie. You could see that bullish divergence and bearish divergence. All right, so we'll go to the US dollar Swiss franc, look at the same thing. Let's go back to that real quick. On this bullish divergence here, you could see where we got into the trade. So we get in here, and like I said, your stop loss would be there. Now you can see that this is the highest high of the market, of the oscillator, but the market continues to go higher, but the oscillator is not going higher. So we need to be careful here, and you can see what we're up against would be this previous month's high. So the market went up to that level, and it looks like the momentum started to die at that previous month's high. All right, also where this level is, so almost like a double top, pretty close. And it came up to that level, and you can see based off of this high and then this high, this is pointing, this one's higher than this one, but on the market here, this is higher. So it's showing the momentum dying on the market. So you may figure that this level is going to hold. You may want to be careful on your trade. So this would, you got in here, you may want to look to start looking to get out of this trade. And then definitely when you close on the other side of the Kijinsen, you want to be out of the trade, right? Okay, so that's basically your rules. All right, so let's go to the US dollar Swiss franc. Look at a few pairs, look at a few opportunities again. All right, so the market is going higher. The indicator is starting to go lower. All right, so you could see here's the high, then it stayed even while the market continued to make higher highs. This stayed even, didn't break the previous high, and then it started to drop. All right, and then here's this high is lower than these previous two, but this one is higher. So that's going to be bearish divergence. Now price, you could see where this price came down hard and broke through this Kijinsen and then hit the cloud, broke through the cloud. Now your stop loss is supposed to be up here at your Kijinsen. That's a big stop loss. Now if you did have your stop loss there, this would have been a good trade and you would have rode this all the way down here. Now we do get out on the break of the Kijinsen to the upside, but we can get back in on the break on the downside because your indicator is below the 50 level. Okay, but if you just move your stop loss with your fractal level, you don't have to get out on that break. You're always going to stay safe with your fractal level. Okay, so here's your fractal level. Then price comes down, makes this level. You're already in here. You're here, so this is going to be your area to get out the trade, to be taken out automatically. You're still safe, so you move down to this fractal level. Price continues to go down, and just move to your fractal level. Now you see price getting above this level and closing up above the cloud or getting up in this level. You want to be out of the trade. All right, but you could see that divergence is strong. It shows a lot of momentum for the move, and you can see how strong the move was. Now here price is coming down, and look at this low of price, but look at the low of the indicator. So here's a small divergence, and we break here. Now this trade probably wouldn't have been too good for you because you would have stayed in this trade a little bit and you would have had a little profit here, but then you would have, price would have came back down and taken you out. So that wouldn't have been too good. Let's see what else we see on here. All right, so here we go again. This is going to be price is going upwards, the indicator is going downwards. So you can see that very clearly. This momentum of the market to the upside is dying. It's getting weaker. You can see that there. All right, but you see the market continuing to go up. So we're looking to get short as soon as we get an opportunity, and our opportunity is going to be when we break the cloud. That's going to be the breakout. So here's a little breakout right here. So you could have waited on this candle, and look where the indicator is. We're below the 50 level, so we can get into the trade. Put your stop loss up above this, up a little bit above the Kijinsen, and what happens? Price goes on down, continues to go down. No need for you to get out of the trade, and continues to go down and closes on the other side of the Kijinsen here, and that's where you're out. Okay, so you're going to look for that divergence in the market. Okay, so here it is again. Here's more divergence. After a long run, you can find it, and you can see. Just look for where the lows of the indicator are, and the lows of the market are the highs of the indicator and the highs of the market. So here's more divergence. Look what's happening with this price. Okay, but look what this indicator is doing. So if you didn't get into that last trade and you're sitting here waiting to see what's going to go on and the market's in this area, you could see that divergence. So now we break out here and we get into the trade. Not a great trade, but still you made a little profit, or at least broke even, but You could see that divergence, and that's how you're going to trade the breakout. So if you don't see the divergence in the market, don't take the breakout and just wait. That'll give you a better chance to make a better trade, a trade that could be in your favor, more higher probability because you have momentum on your side. All right, so let's go to another pair. And here I have a trend line on this pair right here. So we'll start from the trend line, and you can see price going up, the indicator staying about the same, but then price here, the indicator makes a high there. Price goes up, the indicator doesn't go higher than that previous high, so it's starting to show divergence. So that little bit of divergence from this point to this point, now we're looking for our breakout. When we got the breakout, we put our stop loss above this Kijinsen, and we would have been close. It would have been close. The market knows where our stop loss is, and it came pretty close to taking us out if it didn't take us out. Okay, but then it can't. The price dropped down, and would have been a nice little trade, and then price came and closed on the other side of the Kijinsen. All right, so now price is moving upwards. Now here's where price is continuing to move upwards, and the oscillator flattened out and started to break downwards. So we're looking to go short. Now we get to this trend line here, and we bounced on that level, but then we broke that level, so we're in the trade. All right, but now this trade doesn't look too good because you can see here's the low. Let's see what's going on. Here's that low right here, and then here's the next low, pretty close to each other. But the low for the oscillator is higher than the previous low, so that means the momentum to the upside is starting to become stronger. So this could have been a pullback here. Now we're not going to get into the market. If we were in this trade, we may want to move our stop a little tighter, and if we get stopped out, so we'll let price close on the other side of the Kijinsen, and if we get stopped out, then we're out. And now we'll wait to see what the market does, and then if it breaks the cloud, then we'll look at that. But that's how to look at your trade, to see if your trade is strong, if to enter the trade to see if it's becoming stronger or weaker. Let's look at this New Zealand dollar, US dollar. Here you see price moving up. Price is moving up, and the indicator is moving up. Now it moves down, price is moving down. So there was no divergence really here. Now here we go. Price is moving up. Here's the high. Price continues to go higher, so here's the high, stays even, and then makes a higher high. Well, the indicator stays even, and then this high is right here below the 50 level. So this looks like it may be a strong trade. So now we wait. We cross the Kijinsen. That's a signal that there's a possible trend change, and looks like there is. Then price moves back up to the Kijinsen, and now it breaks out. Here's the breakout level. We're below the 50 level. We're in the trade right here. Stop loss is above this Kijinsen here, and you can see this would have been a good trade. And now here's where the trade comes to looks like it's flattening out. And as you see that flatten out, maybe you want to get out of the trade, or you want to move your stop loss tighter. And what's happening is price is moving up against this previous month low, and that's starting to look like it's going to hold as support, because look at what the market's doing. But look what the indicator is doing. It's starting to move upwards. So it's showing that there's buying pressure now, and the markets may move forward, may move higher. All right, so you need to watch out for that. So watch on your trade here, monitor your trade. All right, now this is going to be another case of bullish divergence. So now we would look for a breakout above the cloud if that happens, if this continues to do what it's doing. Okay, and then now we'll finally look at this last pair. Looks pretty much like the New Zealand dollar US dollar that we just showed, but this is the New Zealand dollar yen. Okay, got that trend line here. And now what we're going to look at is going to be looking at this. We're going to look at a double top. I'll put a horizontal line in here. This is going to be the double top. And because here's the high and then here's the high. Now we can see two divergences here. Here's that high. So when we get back up and price gets to this level, this is how you're going to see when you get up against support and resistance levels. Look at that indicator, and it didn't go higher than the previous high. This previous high here, well, this high is down here. It's lower. So the momentum is even weaker. Look, it's way down here. This is it right here compared to this one. So that's showing you that it's lower. The momentum's getting weaker. Now we wait for a breakout. Here was a breakout here. If you had your stop loss up here where you would have been safe. That's a big stop loss. Market moves up, doesn't hit your stop loss if you're there, but it does if you're on this single candle. But then price even breaks below the trend line here. So the trend line held right here, but then price breaks here. This is a good trade to enter now. Okay, but now you can see the momentum heading back up the other way. So maybe this weekly level is going to hold now. This weekly support level is going to hold. So that would have been where you get your profit. You get out on the break of the Kijinsen. Now we'll look to see what the market's going to do there. But that's how you look at that divergence. You want to get on in the trade on divergence. So you're going to always look for the market losing strength. Okay, so this is a move upwards. We're going to look for the market to lose strength. And the way we're going to see that is by the divergence. Okay, you could see that. Well, here it wasn't really because it continued to move up and it moved up higher with this one. But we can even see a small divergence here. Look at this level here. Okay, so here's where we're looking at that level. Here's the high. We'll draw another line so you can see it clearly. Here's this high to this high is going higher. But the indicator from that level, this high to that high, is lower. So we see that and we know that we want to go short when we break the cloud and we break this trend line. So you can see this bearish divergence. Now there's another way that we can trade, and we'll get into that later on another day. We're not going to even have the cloud on here. We're just going to have the Kijinsen, and we're going to trade the divergence. But I'm not going to get into that today, and it's a lot more different rules as far as trading that. So that's an advanced way to trade the breakout levels. It'll help you to have better breakouts and less fake outs. So hopefully that helped you guys. Start studying your charts. Look for divergence. Start looking at divergence. Look to know when you're going to see it. You're going to see it a lot of times at the top or the bottom of a move. You're going to have to look at the indicator and the price, and start looking at it near support and resistance levels. So here's a resistance level up here. Then you got support levels you want to look at, see if you can find any divergences, and then watch what the market does. Okay, when you're using the ultimate oscillator, you want to make sure you get above that 50 level or below that 50 level before you get into the trade, along with being below the cloud. So that'll be always be your regular rules. You need to be below that cloud. Definitely need to be below the Kijinsen, because that'll be the first thing you break will be the Kijinsen, then your cloud level. And once you break your cloud, you want to make sure that you're above or below the 50 level on the oscillator, and then you enter the trade. Stop loss as usual at the Kijinsen. Okay, and you can do this basically with any oscillator as far as divergence. You can use your stochastics, your RSI, MACD, but like I said, this ultimate oscillator is going to be a little bit more reliable and catch more dependable divergences, some that the other oscillators won't catch, and some that the other oscillators are showing that this won't be showing, that will be false divergences, just because of the 3 time frames that it's using, the 7, 14, 28 periods. It's going to give it more reliability. All right, traders, hopefully that helped you guys. Hopefully you learned something. We'll continue to talk about this, get a little deeper into it, And till next time, God bless.